Have you ever wondered how businesses measure how quickly they pay their suppliers? Because paying bills too slowly can damage relationships, but paying too quickly can hurt cash flow. One of the key tools companies use to measure this is called the accounts payable turnover ratio. The accounts payable turnover ratio measures how many times a business pays off its average accounts payable during a specific period. In simple terms, it shows how quickly a company pays the money it owes to suppliers. Accounts payable turnover ratio nets credits purchases average accounts payable. Now let's make that simple. Net credit purchases are purchases made on credit from suppliers. Average accounts payable is the average amount the business owed suppliers during the period. The higher the ratio, the faster the company is paying its suppliers. Let's look at a quick example. Imagine a business made £200,000 in credit purchases during the year. Its average accounts payable balance was £40,000, so 200,000 divided by 40,000 equals 5. That means the business paid off its accounts payable 5 times during the year. Now, why does this matter? Because this ratio helps measure financial efficiency and supplier payment behavior. A high turnover ratio can suggest the business pays suppliers quickly and manages debts responsibly. But if the ratio is too high, it could also mean the company is paying bills too aggressively and not fully using available credit terms. On the other hand, a low turnover ratio may suggest slow payments, cash flow problems, or financial pressure, so neither extreme is automatically good or bad. It depends on the situation. Now, businesses and investors often compare this ratio over time or against competitors to understand payment habits and financial health. Some companies intentionally negotiate longer payment terms to preserve cash flow, while others prioritize faster payments to maintain strong supplier relationships. A common misunderstanding is thinking a higher ratio always means a stronger company. Not necessarily. If a business is paying too quickly, it may reduce its available cash unnecessarily. Another misconception is that the ratio measures profitability. It doesn't, it measures payment efficiency and supplier management. So, what's the key takeaway? The accounts payable turnover ratio shows how quickly a business pays its suppliers during a period. It helps measure cash flow management, payment efficiency, and financial behavior. And once you understand this ratio, you start to see how businesses carefully manage not just profits, but timing, relationships, and the movement of cash itself.